Hey everybody, I wanted to dive in the group a little bit more on a question that came up some in the webinar we did last Wednesday, and it actually came up yesterday when I was talking to somebody as well. And it's a question a lot of people have. And I want to very clearly make the disclaimer before I even get into this that I'm not giving specific investment advice. I'm going to give some general education and some general principles here. So I'm not going to tell you what to invest in, but I want to explain again the difference between stocks and bonds and mutual funds and diversification versus some other stuff. So what a stock is a stock is a piece of ownership in a company. So you are a tiny owner when you own a stock. It's buying an ownership right, a share of the ownership. And then if the company makes money, then you're hoping to share in the profits because you're an owner. If the company's losing money, then that's where the value of the company can go down. A bond, to recap, is essentially a debt. If you are lending the money, then you own the bond, and you're lending that money at a particular rate of interest, might be 4%, 2%, whatever the agreement is, and you're expecting to get that back. Now, sometimes people talk about how rich people buy municipal bonds and poor people buy corporates. And that's kind of a little saying in the industry that points to the fact that municipal bonds, municipality bonds, since they might be used to build a new road or something else that the government's going to use, they sell the bonds to the public. They agree to pay a certain amount of interest rate on that, and then they're going to pay it back at a certain time in the future. And it's usually generally considered to be more secure, and since to the government there's tax benefits often depending on how you do it. And so that's why once assets begin to build, and especially when people are looking at retirement, sometimes they look more at that type of a bond, but they're locking in their money in a debt. Then the corporate is you're selling it to a corporation. You don't have the tax benefits because it is a private business. However, you do typically have a higher rate of interest, and you could do calculations to see if the real rate of return with the taxes is better than what you'd be doing in the government side. But I want to circle around to a real important point before I maybe unpack that a little bit more. No, I do want to say one thing before I go on. When it comes to stocks and bonds, I generally would say I have pretty much the same opinion on this that Dave Ramsey talks about quite a bit. I'm not a big fan of bonds from a just understanding of how they work, because you're lending your money for a certain rate. And the illustration I believe I used on the webinar and how I often try to talk about this is, think about the housing market just a couple years ago. A couple years ago, housing rates were a lot better, right? Maybe 2% for your housing loan, for your mortgage, is what you'd be paying. Now it might be 6, 7, 8%. It's more. If you had bonded your money, if you had lent your money at 2% interest several years ago, you're locked in, right? You would wish you had a way to get out of that, because now interest rates are more. When you play the debt game, you're trying to kind of bet on what is going to happen. When you're in the ownership camp, then as companies are growing and as companies are producing revenue, you get to share in that. That's just kind of a general philosophy I would look at. And I say that simply because generally the advice out there is going to be to take bonds as you get older, because it's quote unquote more secure, more guaranteed income, and stay away from stocks. Again, that's a personal decision. I can't tell you what to do. But from an educational standpoint, understand, are you going to be trading your money at an interest rate for a sense of security, or are you going to be holding on to some ownership? And again, there's different types, which is what I want to get into here. There's different types of stocks and bonds. There's preferred stock, there's cumulative preferred, there's just common stock. Some common stock typically has voting rights. Preferred stock is something where it's preferred, meaning that it would be paid a return above. And if it's cumulative, it kind of functions like a bond. Like, let's say it's a 4% cumulative stock, cumulative preferred stock. This means that, let's say it's guaranteeing 4% return on that, or $4 for just a simple math to illustrate this. let's say it's $4 it's going to pay every year. If the company is not doing well for a couple years and it can only pay $1 one year, $2 the next, well, that first year it by default still owes you 3, and the next year it still owes you 2 because it only paid you 2. So that's 5 plus this current year would be 9, and so when the company's doing better in year 3, it has to pay you everything. That's how preferred stock works. Now they're typically pricier. The common stock has the benefit that it can accrue ownership rights. So if people own enough percentage of a company, this is where they can be using their votes to sway things, to be like a board member, to be able to control the direction of a company. That's why when a business founder retires, they like to hold on to like 51% of the stock. Why? Because they can sell the other and they can reap the rewards and the benefits and grow the company through selling ownership in order to raise capital, typically to grow the company. They're selling ownership rather than selling debt. However, if they keep 51%, then they're able to retain the control and still be able to steer the company even as they move into retirement or an advisory role or pass off, like the CEO type of responsibilities and stuff. The main thing, though, that I want to encourage people to strongly consider about, whether you choose to work with an investment advisor, which perfectly fine, you work with somebody that actually is licensed and has gone through everything to be able to work in helping you manage and select funds, whether you do that or you self-manage, diversification is key, and also taking ownership of the responsibility. You are responsible for all of your investment decisions. Now, there are arrangements out there where you can hire somebody to do everything for you, but I can't tell you how many stories and how many people I know that they invested all their money with somebody and the person was a crook or they stole it. Now, there's a lot of regulation, and a lot of that has cracked down a lot more since like the 70s and stuff when a lot of this happened. It doesn't mean it doesn't still happen, though. And the reason why someone can get into the situation of losing almost everything is because you never should trust anybody to be responsible for your financial future. You are going to need to be involved in understanding what's going on. Never invest in something you don't understand, even if you have some type of a situation where you're letting somebody manage some of the things for you. There is nothing wrong with them having to explain it to you. And ultimately, if you lose the money, it is still your fault in the sense that you made that choice. You made that choice to sign over your responsibility and to not be involved if that is the case. So regardless of how you decide to set it up, diversification is key. What's diversification? Don't put all your eggs in one basket. Don't put everything in one investment. Don't put everything in one single company, like just the stock of one company. That would be enormously foolhardy. Now, as I mentioned, people that found a business may do something like that to retain ownership. But if all of their wealth and retirement is tied up in their own company, it's an enormous risk. What if that company has a lawsuit or it goes under, or whatever happens? If that company undergoes difficulty, then the value begins to drop, or if it forecloses, if the company goes bankrupt or something, or is shut down because of regulatory investigation or what have you, fines, fees, some scandal, then you lose everything. So what is a way to diversify? Well, look into mutual funds. Dave Ramsey talks about these a lot, and I'm a big fan of these because a mutual fund is a collection of multiple companies, in many cases 100 companies or even more. And so what you're doing is you're buying one fund, you're buying a share of a cumulative pile of multiple companies. This spreads out your risk. If I'm spending money, let's say I'm putting $50 in to buy one share of a stock of one company versus putting $50 in to buy one share of a mutual fund in a dozen or 100 companies that are all within this. If there's 100 companies, some may not be doing well, maybe one or two actually go under, some others are doing phenomenally well. It helps even out the returns and it diversifies the risk. There's also different types of mutual funds. There is international, there is global, there is small cap, which are smaller businesses. There's large cap, which is larger businesses. There's growth and income. There's aggressive. There's all these different categories, if you will. And there's even sectors, like if you want to invest in a certain sector of the economy, technology or whatever, or if you want to use an index fund like the S&P 500. The S&P 500 has done what, like around 11.5%, something like that, over the history of the stock market. Now, there's some years it goes down 20 or 30%. There's some years it goes up 10, 9, but on average, that's where it's been, like the whole history of the stock market. And I do just want to say this because I remember when I first started saving for retirement, pretty young, 18, 19, something like that. I started off pretty much right away. But I remember one of the fears I had is, what if the stock market tanks? Like, what if we hear these types of fears. Well, let's look a little bit at the facts. The entire stock market completely tanking. Now, there has, yes, been recessions in history, there was the Depression, but the entire market completely just going to zero is almost impossible. Because what that would mean is that every company that trades on the stock market would have to close and close like that. So if every single major business that publicly trades across the United States or the world that you happen to own shares or bonds in, if everything would close right away and there's some major catastrophe thing, yeah, you could lose everything. But otherwise, no. And the way to diversify risk, again, is to spread it out over multiple sectors, across multiple companies. Don't put everything in risky stuff. And here's something that Ramsey's organization found out about millionaires that is amazing. They've done a lot of research. You can go on the website. You can look at it. They've done enormous studies of how millionaires' behaviors are. Many of them are people that never made a huge income. Teachers are some of the primary people who did not make a big income that become millionaires, because it's about steady consistency and diversification. The average millionaire, Ramsey actually found, only takes 10 to 15 minutes to look at the track record of an investment and to make a decision. And then they make a decision, and you know what? Many millionaires have marginal investments. It's not like they find some silver bullet. And that's the conversation I think that I tend to have more often than not. Somebody wants to start investing and then make money real quick. And I would just encourage you, look at Scripture, look at the Proverbs. It says that faithful saving little by little, I'm paraphrasing slightly, but the one who gathers, it says little by little, okay, patiently saving little by little, they're the ones that see the increase. But wealth hastily gained comes to ruin, comes to nothing. You know, if somebody wins the lottery, their behavior, their discipline has not changed. Most people that win the lottery end up in enormous debt and then bankrupt within a few years. Just having more money does not change behavior. If you're greedy with $100 or no dollars or $1 million, it doesn't matter how much money you have. The heart is still the problem. And one of the things that the Lord intends for us to learn through managing money, and Jesus talks about this in his parables. He talks about money enormous amounts of time. When he talks about the parable of talents, that's not talking about what are your skills. Literally, a talent was a weight of precious metal. And those people were to take it and invest it. Another guy just buried it in the ground. He's afraid. He doesn't do anything. And Jesus rebukes him as wicked and lazy. He should have at least put it with the bankers, Jesus says, and gotten some interest. So for those out there that don't believe that banking is biblical at all and hyper speculative, just bear in mind what Jesus actually said about money there. I'm not saying be foolhardy. Look at the track record. Look at, is there like FDIC insurance? Is there different things that can protect you to help you to manage your risk well? Certainly be wise. But just sitting on it is not going to work. And it's not even a biblical principle. The biblical principle is to save little by little, to be faithful, to continue to grow, and to know the state of your flocks. Now, many of us watching this probably don't have goats and sheep and cows and chickens and flocks like that, but we need to know the state of our flocks. If you run a business, you need to know the numbers. Okay, many people will say even on a daily basis, if not a weekly or monthly, you need to have a check-in time where you know exactly where the business is. You know, do you have savings in the bank? What are the expenses going to be? If you're going to run a business and have employees or even just pay yourself and make a living for your family, you have to know those numbers. It's the same thing when it comes to personal finance. And there's apps that can connect your different stuff and help you pull up and see your net worth and help you to track things. There's a lot of tools out there today that make it a whole lot easier than it used to be. But what you have to do is you have to take responsibility. And what Scripture talks about over and over again is about faithfulness and building discipline and teaching us contentment and delaying gratification and being strategic and consistent with our saving and with walking with wisdom. We've talked about insurance at different times in this group and how you can manage the risk for your family, whether that's health or that's life insurance, and people are dependent on you to provide for them or for your income to be part of the household bill paying. That's an important component, and life insurance is a tool to be able to help manage that risk. Disability, if you were to become disabled and lose income, having an emergency fund to be able to self-absorb some of these short-term things and self-fund a short-term disability rather than paying the more expensive coverage for something that goes into effect for a shorter-term disability. All of these things basically boil down to discipline and wisdom and attempting to save for a rainy day and being creative, trying to manage the best with what we have to be good stewards. At the same time as trying to protect our family and be disciplined and wise, we also want to have generous hearts, because one of the coolest things you can do is give away money. And you tend to want to give and invest in people who are really trying. Dave shares stories all the time how he'll walk into some type of a Waffle House or something on like Thanksgiving morning on the way to a family dinner, and just stops in there, gets a cup of coffee, and sees somebody that's working, might be a single mom, somebody that is working hard, and they're just trying to pay the bills. They have to work on a holiday because they have to work, and give them a massive tip. What if you gave $1,000 or $500? What if you know a single mom at church, or somebody that's really struggling that needs a car, and you just gift the car? You can do a lot of these things anonymously too. You don't have to be known for doing it, but it is an enormous blessing. And a great way to combat greed is to be generous. All of us, if we're honest, deep down, have some selfishness of wanting to hold on to things or wanting to spend on ourselves. And as we grow and mature, as we become more disciplined and we become wiser in how we're living and we learn what really matters, we tend to lessen on those things. So it's not like people learn these lessons just in trying to learn financial lessons. I'm thinking of a conversation I had recently where someone was willing to get rid of more things in their life. They were willing to make adjustments for something that really mattered in their life. They had come to see and just value even more how important that was. Throughout our life, what the Lord is focused on is building character. So when we talk about money and we talk about our calendars and why are people so anxious and exhausted, whole nother thing on that. Well, we typically don't rest. We don't actually take a whole day like God designed and rest and have that mental health and unplug from our phone and be with our family and just take a nap and have some leisure activities. We are such a busy on 24/7 accomplishment driven society. We're causing some of the things, if not a lot of the things around us and to ourselves, even a lot of our health, because we are not following God's design. What the Lord is after ultimately is your character, not about how big a pile of dough you have. There's nothing immoral about wanting to be wise so that you can give more generously, so that you can be free from the bondage and slavery of debt, which is what Scripture calls debt. It's slavery, so that you can be in a position where you're not dependent on other people to care for you later on. It's a great goal to want to save and be prepared so in your later years you are able to draw off of something to take care of yourself and your spouse when you're older and not completely dependent on somebody. That's not a situation that everybody finds themselves in, but I know a lot of people have that desire to have dignity of, I've taken care of myself. I would even go so far as to say it's a very immoral mindset to just trust society or government or family to take care of everything for you. There is something right and good about doing what we can to take care of ourselves. Now, we may not be able to. There are health conditions. There are things that happen where it's out of our control. But doing the best we can to take personal responsibility, man, there's tons of scriptures we can look at that. But simply expecting everybody else to pick up the pieces and take care of everything for us, there's a lot of scripture about that being lazy and about that being pretty foolhardy. So when it comes down to these things, my main takeaway, I guess, in a nugget is to simply encourage diversification. Spread things out. Don't put all your eggs in one basket. Ecclesiastes talks about that. Spread your portion to 7, yes, 8, and also cast your bread on the waters, which I think is a reference to generosity. You don't know when it's going to come back to you. We don't give to get. We give to be generous. We give to show the love of Christ. We give to help others. I can tell you, though, when you become focused on putting the Lord first in your life and on combating a heart of greed, developing discipline, developing contentment, it also just seems like things begin to fall in place. And let me illustrate it with this, and then I'll close today in our coaching group. When someone is trying, when someone is putting one foot in front of the other in a hard situation, or they're trying to improve their situation, people tend to come around and want to help. Also, things tend to start falling in place. Like, I know tons of stories of people who they began to, whether it was in their career or their finances or their marriage, their relationship, their walk with God, whatever it was, they began to take personal ownership and to try to grow, and then things began to fall in place. Maybe they always longed for a mentor or a small group of people in their spiritual walk that they really could depend on. When they began to take some personal ownership, it seems like then those other people they longed to have as part of that team kind of fell in place. Here's the reason why. If someone is not going to take personal responsibility, would you want to invest time in them? Would you want to be trying to speak truth to somebody that just ignores you constantly and just laughs it off or just ignores it? At some point, you're probably going to try to give up. You may really care for and love somebody, but you're not going to keep investing your energy in somebody that's rejecting wisdom and is choosing foolishness. It's the same thing in life. And it tends to be the same thing in your finances too. When you really begin to work on these things and to try to take personal responsibility and put God's principles to work, it just seems like things that you never expected begin to happen. So I hope you can take that hope away today. Begin where you can. Trust God with the results. But begin to walk in as much wisdom as you can today and take the tiny step you can today or tomorrow, this week. What can you do today? What can you do tomorrow? What can you do over the course of this week? Over the course of an entire year, those things really add up. If every week you are able to make a 1% improvement, let's just take finances, for example, you would be 52% improved by the end of the year. That's a major difference in your saving and your discipline. So take that small step, get going in the right direction, be wise, spread out what you're doing appropriately. Don't put all your eggs in one basket. Begin to walk in wisdom, recognize the character that God is after, and just begin doing those reps. Just like you would to lose weight or improve in a sport or to get faster at running or whatever goal you would set, improve your health, your diet. It is consistency. And no, one day you may fall on your face. That's okay. Get back up the next. Don't stay down. Maybe you've been down a couple of days or a week or a month or even a couple of years. Get back up. The only bad thing you can do is to refuse to keep trying. Make the choice and keep making the choice. Improvement will follow.